All right, ready to dive deep. Today, it's macroeconomics and financial markets.
Sounds complex.
It can be, but it's super important for ACCA students,
Mhm.
especially for the FM exam. Think government policies, financial institutions, even a bit of fintech.
All connected to the real world.
Exactly. This stuff affects every business decision, every investment strategy, everything.
Absolutely crucial to understand.
Okay, so first, the big picture. Macroeconomic policy targets.
The goals governments set for their economies.
Right. And our notes highlight 5 big ones.
Economic growth, full employment, price stability.
Balance of payments, stability, and sustainability.
They might sound a little textbooky, but
But they have a huge impact on businesses and individuals.
think about it. When an economy grows, businesses can expand, hire more people. Everyone benefits.
Like a rising tide lifting all boats.
Exactly.
But what happens when the tide goes out? I remember a few years back, the economy tanked, and my friend, who owns a small business, had to lay off half his staff. It was rough.
Yeah, economic downturns can be devastating, especially for smaller businesses.
So governments are always trying to find that sweet spot, right? Encourage growth, but also prevent things from overheating.
A delicate balancing act. And it's not just growth. Full employment is another key target. More people working means more money earned and spent, which fuels the economy.
Makes sense. But then there's inflation. Prices seem to be going up everywhere these days.
Absolutely. Price stability is a major concern. Runaway inflation erodes savings, makes it hard for businesses to plan, creates a lot of uncertainty.
It's like your money is literally losing value every day.
Exactly. And then there's balance of payments stability.
That one sounds a bit complex.
It's about ensuring a country's financial interactions with the rest of the world are sustainable.
So, like, if a country imports way more than it exports, that could be a problem.
It could. It can lead to currency fluctuations, debt, all sorts of instability. Governments use different policies to manage this balance.
Okay, and finally, sustainability. Seems like that's getting more and more attention, especially with climate change.
It's a necessity now. Governments are implementing policies to promote sustainable practices, and businesses need to adapt,
It's interesting how all these targets are interconnected.
like a delicate ecosystem.
And to manage it, governments use various tools.
Fiscal policy, monetary policy, interest rate policy, and exchange rate policy.
Each one has a direct impact on businesses and the economy.
Right.
Let's break those down. Starting with fiscal policy, what's that all about?
Fiscal policy is about government spending and taxation. Governments can use these to stimulate the economy or cool it down.
Okay.
Like if they want to boost spending, they might cut taxes, giving people more money to spend.
So it's like giving the economy a shot of adrenaline.
Exactly. And if they need to curb inflation, they might raise taxes to reduce spending.
Makes sense. Then there's monetary policy, something to do with central banks and interest rates, right?
Right. Monetary policy is controlled by central banks, like the Federal Reserve in the U.S. They manage the money supply and interest rates.
So if the central bank raises interest rates, does it make it more expensive for businesses to borrow money?
Yes, exactly. Higher interest rates can slow economic growth, but also help curb inflation. It's a balancing act.
Okay. And what about interest rate policy and exchange rate policy? How do those fit in?
Interest rate policy focuses on managing the overall cost of borrowing. This affects businesses' investment decisions.
I see.
Exchange rate policy involves influencing the value of a country's currency compared to others.
How does that affect businesses?
This can impact the competitiveness of exports and the cost of imports.
So we've got these big levers governments are pulling. But how does it all actually affect businesses on the ground?
Well, the notes highlight 4 key areas: competition policy, government assistance, green policies and sustainability, and corporate governance regulation.
Let's unpack those. Our listeners want to know how this translates into real-world impact.
Absolutely. Let's start with competition policy. Imagine a marketplace where one giant company controls everything. They set prices and consumers have no choice. That's where competition policy comes in.
So it's like a referee making sure everyone plays fair.
Precisely. Competition policy aims to prevent monopolies, promote fair competition, and protect consumers.
Got it.
When markets are competitive, businesses have to innovate, offer better products, and keep prices down.
Like survival of the fittest in the business world,
Exactly. And then there's government assistance,
which can be a lifeline for businesses.
especially startups and small businesses. We're talking grants, subsidies, tax breaks, things that ease the financial burden.
When I imagine there's a catch.
There can be. Government assistance often comes with strings attached,
Like what?
like compliance requirements and reporting obligations. But for many, the benefits outweigh the hurdles.
Now, green policies and sustainability. That's a hot topic.
Yeah.
Governments are trying to combat climate change, and this has a major impact on businesses.
Absolutely. We're seeing new regulations and policies aimed at reducing carbon emissions, promoting energy efficiency, and encouraging renewable resources.
So businesses have to adapt.
They do. And many see this as an opportunity to become more sustainable and appeal to environmentally conscious consumers.
So it's not just about avoiding penalties. It's about being a more responsible business,
Exactly. And lastly, we have corporate governance regulation.
which ensures companies are run ethically, transparently, and accountably.
It's about more than just making money. It's about doing business the right way.
Right.
Strong corporate governance builds trust with investors, customers, and the public. It's about responsibility, risk management, and ethical decision-making.
Like the moral compass of a company.
That's a good way to put it. Now, let's shift gears to financial markets and institutions.
Mechanisms that connect savers with borrowers, facilitate trade, keep the global economy humming.
Exactly. And our notes start by differentiating between money markets and capital markets.
Can you explain the difference?
Think of money markets like the short-term lending window. Businesses go there to manage day-to-day cash flow needs. Short-term debt securities, typically maturing within a year.
So it's like a quick loan to cover immediate expenses.
Exactly. Capital markets, on the other hand, are where businesses raise funds for long-term investments.
Like building a new factory.
Right. This is where you'll find stocks and bonds, investments that fuel company growth for years.
Okay, so money markets are short-term, capital markets are long-term.
And these markets aren't just national, they're global,
Businesses today can access capital from all over the world.
creating both opportunities and challenges.
It's amazing how interconnected the global financial system has become. But how does it all work? Who are the key players making it happen?
That's where financial intermediaries come in. They connect savers with borrowers.
So like matchmakers of the financial world.
Exactly. Banks are a prime example. They take deposits and lend that money out. Insurance companies pool funds to cover potential losses. And mutual funds allow investors to diversify their portfolios.
They all play a crucial role.
They provide liquidity, reduce risk, and help ensure efficient capital allocation.
Now, let's talk about the stock market and the corporate bond market. The markets we hear about in the headlines.
The stock market is where companies issue shares of ownership, known as stocks, to raise capital. Investors buy and sell these shares, driving prices up or down.
Like a constant popularity contest for businesses, with investors placing bets.
That's a good analogy. And then you have the corporate bond market. Companies issue bonds, essentially borrowing money from investors,
And bonds offer a fixed rate of return.
making them popular for investors seeking steady income.
So stocks are riskier, but with higher potential returns, while bonds are more stable but offer lower returns.
Exactly. It's about finding the right balance for your goals and risk tolerance.
Now on to fintech, which is disrupting traditional markets and institutions.
Fintech leverages technology to provide financial services more efficiently, accessibly, and innovatively. It's transforming everything.
It seems like new fintech companies are popping up every day.
It's a very dynamic space. Online trading platforms and robo-advisors have made investing more accessible. Crowdfunding and peer-to-peer lending are connecting borrowers and lenders directly.
It's like fintech is democratizing finance,
Exactly. And then you have blockchain and cryptocurrency.
which are changing how we think about money.
Absolutely.
It's definitely a space to watch. Understanding these trends is a huge asset for any ACCA student.
Absolutely. Now let's focus on the money markets. We talked about their role in short-term funding, but our notes highlight 3 key functions.
Liquidity provision, trade finance, and risk management.
Right.
We know liquidity is about having cash when you need it. How do money markets play a role?
They provide a mechanism for businesses and governments to access short-term funds quickly. This helps them manage cash flow, meet obligations, and keep the economy running smoothly.
Like a financial emergency fund.
Good analogy. And then there's trade finance, another crucial function.
Especially important for international trade.
Absolutely. Trade finance involves providing short-term financing for import and export transactions. This can be crucial for businesses needing to bridge the gap between paying for goods and receiving payment.
A financial safety net for international trade.
Exactly. And finally, risk management. Money markets provide tools to hedge against currency and interest rate fluctuations.
Super important in today's volatile world.
It is. And to fulfill these functions, money markets rely on a variety of instruments.
Which we can categorize into three types.
Interest-bearing instruments, discount instruments, and derivative products.
Okay, let's dive into those. Starting with interest-bearing instruments, what are some examples?
Treasury bills are a classic example. Short-term debt securities issued by the government, considered one of the safest investments. Then you have certificates of deposit offered by banks.
I've heard of those.
You lend money to the bank for a fixed period and receive a fixed interest rate.
So these are relatively low-risk instruments with a predictable return.
Exactly. They're popular for investors seeking safety and liquidity. Now let's move on to discount instruments. They're issued at a discount to their face value and mature at par.
Okay.
The difference between the purchase price and the face value is the interest earned.
Our notes mention commercial paper. How does that work?
Commercial paper is unsecured, short-term debt issued by corporations to finance their short-term liabilities, like payroll or inventory. It's issued at a discount and matures in a few months.
So it's like a short-term IOU from a company.
Exactly. It can be a cost-effective way for companies with good credit to raise short-term funds.
All right. And lastly, derivative products. Financial instruments whose value is derived from an underlying asset.
Like a stock, bond, or commodity.
Right.
Derivatives can be used for a variety of purposes, but in money markets, they're primarily used for hedging, managing financial risk.
The notes mention futures contracts, options, and swaps. Can you give us a real-world example?
Let's say a company needs to buy a large amount of oil in 6 months. Oil prices are volatile, and they could rise significantly. To protect itself, the company could enter into a futures contract to buy oil at a predetermined price in 6 months.
So they lock in the price today, even though the transaction happens later.
That's right. This way, they know exactly how much they'll pay, regardless of market fluctuations.
A brilliant way to manage risk.
Exactly. And that's just one example. Options give the holder the right, but not the obligation, to buy or sell an asset at a specific price within a certain time frame.
Okay.
Swaps are agreements to exchange cash flows based on different financial instruments.
Wow. There's a lot to learn about financial instruments.
It is a lot, but for those pursuing a career in finance, especially as an ACCA professional, understanding these instruments is essential. They're the tools of the trade. The better you understand them, the better equipped you'll be to navigate the complex world of finance.
Okay, so we've talked about these big instruments. Futures, options, swaps. They sound pretty sophisticated. But wouldn't you say that even understanding the simpler money market instruments is super important for someone studying for the ACCA FM exam?
Absolutely. Think about it. These instruments, they're the building blocks of the financial system. If you're going to advise businesses or make investment decisions, you need to know how they work, their risks, rewards, how they fit into the big picture.
So let's get into some specifics. We were talking about interest-bearing instruments, like treasury bills and certificates of deposit. They seem pretty straightforward. You lend money, you get paid interest. What's the catch?
Well, the catch, if you want to call it that, is the return. They're generally considered low risk, which means compared to riskier investments like stocks, they offer lower returns. It's the risk-reward trade-off.
So if I'm risk-averse, I might be happy with the steady, predictable return of a treasury bill. But if I want higher potential growth, I might go for the stock market.
Exactly. It all depends on your goals and your risk tolerance. And remember, even within interest-bearing instruments, there are nuances.
Got it.
A treasury bill backed by the U.S. government, extremely safe. But a certificate of deposit from a lesser-known bank might carry a bit more risk.
So it's not just the type of instrument, but the issuer and the economic climate, too.
Precisely. Now, let's talk about discount instruments, like commercial paper. Companies often use these to raise short-term funds. What would you say the advantages are over a traditional bank loan?
Well, wouldn't it be faster and maybe cheaper to tap into the money markets directly through commercial paper?
Often the case, especially for companies with good credit ratings. They can bypass banks, access a wider pool of investors, potentially get better terms. But there are also risks.
What kind of risks?
Well, commercial paper is unsecured debt, meaning it's not backed by collateral. If the issuer has financial troubles, investors might not get their money back.
Oh, I see.
That's why credit ratings are so important. Investors want to know they're lending to companies with a good track record.
It's a trust exercise in the financial world.
Exactly. Now, on to those fascinating but complex Derivative products, we talked about futures contracts earlier. Any other real-world examples of how a business might use those?
Sure. Let's say you're a farmer, worried about the price of corn dropping before you harvest.
Okay, yeah.
You could enter into a futures contract, sell your corn at a predetermined price, lock in your profits, protect yourself from a price decline.
Great example. Highlights a key benefit of derivatives: risk management. Businesses use these instruments to hedge against uncertainty, whether it's commodity prices, interest rates, exchange rates.
It's like a financial safety net, right?
Good analogy. But derivatives can be complex and carry risks, not suitable for every investor.
So you need a deep understanding before using them.
Absolutely. Now let's go back to those financial intermediaries. They play a vital role in the money markets, connecting borrowers and lenders, facilitating the flow of funds. But I sometimes wonder if all this adds unnecessary complexity.
That's interesting. Couldn't you argue that cutting out the middleman would be more efficient? Connecting borrowers and lenders directly?
There's a case for that, and we're seeing it with fintech. Peer-to-peer lending platforms connect borrowers and lenders directly, bypassing traditional banks.
So fintech is disrupting the role of financial intermediaries.
In some ways, yes, but it's not that simple. Financial intermediaries still provide expertise, manage risk, ensure stability.
Sounds like the financial landscape is evolving rapidly. Technology is playing a bigger role.
It absolutely is. For those pursuing a career in finance, it's an exciting time.
Right.
Those skills you're gaining as an ACCA student, they're going to be so valuable.
Speaking of skills, our notes emphasize understanding not just the instruments themselves, but the context they operate in. That means macroeconomic policies, regulations, the interplay between different markets.
It's all connected. You can't really understand money markets without understanding the forces shaping them.
Which brings us back to those 5 policy targets we talked about earlier.
Yeah.
Economic growth, full employment, price stability, balance of payment stability, and sustainability. They're not just abstract concepts.
Right.
They have a real impact on businesses and the financial system.
Exactly. Let's look at inflation. If it's rising rapidly, central banks might raise interest rates to cool the economy down. That affects the cost of borrowing in the money markets, influences decisions about investment.
It's a chain reaction.
It is. Understanding those connections, that's what makes a great financial professional.
So for those studying for the ACCA FM exam, the key takeaway is to see the big picture.
Absolutely. Don't get lost in the details. Step back. Understand the broader context.
It's like being a detective, piecing together clues to see how it all works.
Great analogy. And besides the big picture, it's crucial to stay informed about current events and trends.
That's where things get really interesting.
Absolutely. The financial world is always evolving. New technologies, new regulations, new challenges.
Wow, we've covered so much in this deep dive into macroeconomics and financial markets. From government policies to those sometimes confusing money market instruments, it feels like we've gone from the big picture right down to the nuts and bolts.
It's all connected. And for an ACCA student preparing for the FM exam, understanding those connections is key. It's not about memorizing definitions. It's about applying those concepts to real situations, analyzing complex scenarios, making informed decisions.
So let's say I'm an ACCA student, right? I'm in the exam, and I come across a question about money market instruments. What are the key things I need to remember?
Well, first off, you need to know the different types: interest-bearing, discount, and derivative. And then understand the characteristics of each, the maturity, the risk, the typical uses.
So it's not just knowing the names, but understanding why a company would choose, say, a treasury bill over commercial paper.
Exactly. The exam might give you a situation, a company needing short-term funds, and you have to recommend the best instrument for their situation. You need to consider their financials, their risk tolerance, the market conditions.
It's like a deep understanding of both the theory and the practice.
It is, and that's where the real learning kicks in, when you can connect that theory to the real world.
Okay, let's put it to the test. We're advising a company that needs short-term funds for working capital. What factors do we consider when recommending a money market instrument?
Well, first, we need to look at their creditworthiness. If they have a good rating, they might be able to issue commercial paper at a decent rate. But if their credit's not so good, they might have to go for a more expensive bank loan, or maybe even a secured loan backed by collateral.
So credit rating's a big one. What else?
The time horizon. If they only need the money for a few weeks, a treasury bill might work. But if they need it for months, maybe a certificate of deposit is better.
And wouldn't the overall economy play a role too?
Of course. If interest rates are climbing, borrowing costs more, no matter what instrument you use. And if the economy's shaky, investors get more cautious. Might be harder for a company to issue debt.
So many factors, all linked together. It's like a puzzle. All the pieces affect each other.
That's why it's so important to see the whole financial system, see the forest and the trees.
So for those starting their ACCA journey, what advice would you give them to really get this stuff?
Don't just memorize, try to understand the why behind the what. Read the financial news, analyze real cases, see how these concepts play out in the real world.
And never stop asking questions, right?
Absolutely. Curiosity is key. The more you ask, the more you learn.
Well, that brings us to the end of our deep dive. I have to say I've learned so much. It's a complex world, finance, but it's fascinating once you start to see the connections.
It's been great sharing this with you and with our listeners. We hope you've gained some insights, maybe a new appreciation for the world of finance.
And to all the ACCA students out there, best of luck in your studies. Remember, the journey matters just as much as the destination.
Keep learning, keep growing.
And who knows, maybe one day you'll be the expert guiding others through this world.
That's right.
Thanks for joining us on a deep dive. We'll see you next time for another exciting exploration.